Good morning, everyone. Welcome to this update for global stocks and commodities for the 25th of August. Another incredible week in markets. We had obviously the Fed statement, which was widely expected and pretty much met expectations on Friday. But all the disruption was caused in this US-China dispute, which is certainly escalating. We saw China impose additional tariffs on Thursday, and then the response from Trump on Friday was explosive, and it really blew markets up at the end of the week. So the question is this a game changer? Because some of the things that Trump said really have incredible ramifications if he follows through on it, and I mean that's the difficult one to know. He's so unpredictable that it's impossible to know how this could play out. But I'm going to on the next slide just cover what it was he said and let you make up your own mind as to the to the potential ramifications of that. So let's jump into it. Quite a bit to cover. So really, it's about the ramifications of this dispute, which are escalating very, very rapidly. And of course, it begs the question, should we be looking at making a shift in our strategy? Is that warranted at this stage? And as you know, over the years, I've been steadfastly resilient to the shorter term moves in the market. And my mantra has always been to trade what you see, trade what it is that markets are doing, and not what you think should unfold. And that's certainly paid dividends. So I'm not suggesting that a shift in strategy is warranted, but I'm certainly saying that everyone should examine where they're sitting at the moment. It will be the normal stock and commodity trend update. And Portfolio Analyst last week, we covered the Australian ETF market and the gold sector. Now, this is what Trump said on Friday late. We don't need China, and frankly would be better off without them. How the number one economy in the world doesn't do business with the number two economy in the world is just beggars belief. Our great American companies are hereby ordered to immediately start looking for an alternative to China, including bringing your companies home and making your products in the USA. Now, if there's follow through to that sentiment, that has extraordinary and completely unknowable ramifications. Global supply chains have been put together over decades and decades, and to unwind them in a shorter space of time is going to be unbelievably disruptive. Now, I'm not saying that might happen because Trump might be forced to back off, but that is effectively what he said. So this is certainly a dramatic escalation, and it's incredibly difficult to predict where this might go. In fact, it's impossible to predict. So we have a much greater level of uncertainty. As I said, the global supply chains have evolved over many, many decades. What are the impacts of suddenly changing that, shifting the balances, manufacturing companies having to change their supply to different sources? How do those different sources ramp up? It's an incredible situation. Even if it doesn't really lead to anything overly significant in terms of change, what does it do to business confidence about investing and hiring? Because businesses only do that if they're confident about where government policy is going to be and where they can invest and make a decent return for their shareholders. So if you take that confidence away, then businesses are just going to stop investing and stop hiring. So this has enormous ramifications. And of course, as far as stocks go, what will be the impact on some of the really high PE stocks? Will they be derated? Now, again, I'm not saying that they will be, but we've got stocks like Microsoft on 25 times earnings for this year, Amazon on 70 times earnings. Does the market decide that in this environment of much higher uncertainty that those PE multiples aren't appropriate? If you look at Australia, we've got a lot of these really high-flying tech stocks that are still amazing growth stories. But we've got WiseTech Global as one example, trades on a PE of 120. We've got one of the market darlings in Afterpay Touch trading on a 2020 PE of 180 times. Does the market look at that and say, well, given all this uncertainty, we can't justify those sort of PE multiples anymore? Now, I'm just posing the question. I'm not predicting anything, but this is a very dangerous environment that we find ourselves in now. Now, I just want to make one other point, and that really, gets to the heart of this. This uncertainty can cause traders and investors to do strange things that months later, you kind of find yourself questioning how you could have possibly made that decision. So I just want to touch on this point. It's really important to be aware of personal biases. We all have them. They're unavoidable, but it's how we manage them. And if we start with preconceived notions, and we all have preconceived notions about all sorts of things, then most of what we read and most of what we find will confirm our existing beliefs, because that's how the mind works. And we will give far less consideration to alternative points of view. So you just got to accept that that's how we're wired. But it's incredibly dangerous, because once you make certain assumptions about the market, then what you do is you close off the potential to seek other alternate ways of action. So the key is just, it's never been more important, and particularly in these times of uncertainty, is to listen to the market. You watch the price action of the market, interpret what the price action is telling you about where the where the major players are putting their money. It's never been more important than it is now to observe and watch and consider what the market is doing. Now, I also just want to touch on where is the bubble, because in this period of great uncertainty, and I mentioned a number of really high PE stocks, it's very easy for people, again, you might have a bias, you might have a personal bias that you think that markets are overvalued. And maybe that's based purely because they've been going up for 10 years. And so therefore they must be overvalued, but that's not necessarily true. And if we look at the US stock valuations at the moment, the PE ratio for the S&P 500 is currently 17.7 times for this year, and it drops to 16.2 times if the projected earnings for 2020 are realised. Now, the median from 1953, so that's a pretty big sample, is 16.6. So this year and next year is slightly above and slightly below the median over the last, nearly 7 decades. So the US stock market is not overvalued as a whole. Now, within that, of course, some stocks are at very high PE multiples, and like Amazon at 70 times, and it's possible the market might derate those stocks for a period. I don't know, but it's possible. Now, if we look at where the bubble is in the bond market for reasons that I've covered many, many times in previous months, and I'm not going to cover it again, other than just to show you what the stats are. The current yield, the 10-year yield on US Treasuries is 1.6%. That equates to 64 times PE. So it's 100 divided by 1.6. The median from 1953 is 18.9 times. So it is, 4 times? Not quite 4 times the long run median multiple for bonds. So it's pretty easy to see where the bubble is. So it's not in stocks, but it's possible that at a higher end of the valuation scale that there could be some derating. And so when you're looking at your portfolio and examining the stocks that are in it, and I really encourage everyone to do that, then you just need to push aside your personal biases, the stocks that you're in love with, the stocks that you don't like. Push all that aside and just try and look at them dispassionately and ask yourself whether they're the sort of stocks that should be in your portfolio. Now, turning to the actual market, the S&P only ended up falling 1.5% for the week, but it was a fairly nasty decline on Friday. The Fed really said nothing new. They pretty much met up market expectations. They didn't change rates, but they left the door open to lower rates and made it very much data dependent. So nothing there, and the market responded actually positively initially. The market actually went up after Powell spoke, but it was the escalation that of Trump's tweeting that really tipped markets over the edge, and there was a very sharp decline into the close on Friday. Now, whether this is yet again just another one and done, and the markets just keep bouncing around in this area, I have no idea. But I'm certainly, on the strength of what Trump said, I'm certainly more concerned than I have been for some time. So, and I have to choose my words very carefully here because, some people interpret what I say in all sorts of different ways. But I think it's fair to say that I now have more concern because that's a fairly serious thing that he is proposing, to basically break global supply chains. That is very serious. So I have greater concerns than I've had for a long time. That doesn't necessarily mean that I will make radical changes to what I'm doing, because I probably will not. But I'm certainly open to the idea of changing some of the strategy that I'm employing. On the positive side, sentiment is so bad that you never get market tops, and I said that last week. You never get market tops when sentiment is this bad. So it may, in a perverse sort of way, help to support stocks. Technically, we're still in an undecided zone. We're still stuck between the 50-day and the 200-day moving averages, as we'll see in a minute. So it's pretty hard to be definitive about about listening to the market. Beg your pardon. The poorer market depth, this time of year, still summer holidays in America, the poorer market depth is certainly exacerbating the volatility. The computer algorithms are trying to buy and sell into a less liquid market, and that's certainly not helping. But the other thing that's certainly not helping is the White House rhetoric is really playing with fire. Markets are very highly leveraged these days, and in a lower liquidity market, saying very inflammatory things, who knows what sort of short-term cascades that this sort of stuff could trigger. So that's where my concern is stemming from. We've got all these things happening together, a lower liquidity market, we've got highly inflammatory remarks being made, and it could just trigger off some things that we don't want triggered off. And once that cascade starts, it tends to play out for a period of time until it finds a new lower level. So that's sort of the thing that's exercising my mind. The US dollar dropped quite sharply, and of course gold rallied $30. I'm surprised it didn't actually go up a little bit more, considering not only did the dollar fall, but there must be a higher level of concern and fear. In fact, in a sense, I'm a bit surprised that equities didn't fall further. So, look, that may still yet be to come next week. But given the implications of what Trump said, perhaps the market didn't respond as badly as it could have. Anyway, that's all conjecture. Let's have a look at the charts. So we're listening to the market. So here's the monthly chart. You can see it's really not that dramatic on the monthly chart at this point in time, but be open-minded to what might unfold. So there's Friday. The market had gone up a little bit prior to Friday, and then of course we got this very sharp sell-off. But we still are in this phase here between 28.30 and 29.45, and until we break below the 200-day moving average, if that were to happen, then we've still got a sideways market, and that's the way that we should sort of play it. So that's the S&P. If we look at the dollar, so quite a sharp move down in the dollar on Friday. Let's look at Aussie stocks. Our dollar fell to 67.5, and I think this trade dispute is going to maintain the downward pressure because obviously it's not going to be helpful for China, it's not going to be helpful for global growth, and under those sort of circumstances, the Australian dollar is never going to do well in that sort of environment because, you know, we are a commodity currency, and it's hard to see commodities doing well when global growth, and specifically China, is going in the wrong direction. Having said that, though, the US economic data, the consumer data, is actually still quite positive. So that's the good side. And a lot of the transport data is still very positive. And as I said last week, the consumer in China is still looking, still looking pretty good. You know, look at Alibaba's results; they were great. So it's not all doom and gloom. That's for sure. Now, our index ended up rising 1.8% on the week, but Monday could be quite nasty. It's really hard to know, and that'll be a bit telling, I think. If the Australian market is down by 3% or something on Monday, then I think it's likely you're going to see more downside in the US market. So I think we might actually get some insight as to how the US will go Monday night during Asian trading tomorrow. So let's just look quickly at the ASX 200. Not that I pay a great deal of attention to this index because it's just represents such a small part of the Australian market. But look, we did have a bit of a rise, but I would think every chance we could get down between 63 and 6,400. I hope that's not the case. I hope our market ends up more resilient than that, but we'll have to wait and see. Turning to gold, there's gold on a weekly chart. You can see it's been a very, very sharp move. Gold was last at a point of stability and not trending mid to late May, and since then it's basically just gone straight up. It's been an amazing run. So we've run from 1276 and we're now at 1527. That's a very big move in gold, and there we are on the daily chart. So you can see the response that we had. So initially gold sold down on Friday. So that was after Powell's comments. Stock market went up, the gold price went down, got down to 1480, and then just rallied very, very sharply from those lows once Trump got his mobile phone out. Okay. Oh, and I'll go back and look at GDX in a minute. So gold rose $13 to 1527. That's the highest close this year, and the Australian dollar gold price is now at 22.62. So an incredibly profitable position for unhedged Australian gold producers. GDX up 44% since late May. There's just been a couple of single week pauses, so I'll just go to that chart now. So there's GDX on a weekly basis. So that's where we were. We were at $20.40 in late May, and now we're at $29.64. And you can see we had 1 week here, 1 week pause there, 1 week pause there, and we're probably steady on that week there. But other than that, it's just been straight up. And when markets are trending this strongly, you've just got to go with the trend. So certainly gold and gold stocks looking extremely good. Turning to other commodities, copper was down a couple of cents to 256. Crude went down to 54.17. Certainly the lower US dollar would have helped there to a degree. But there's a very clear downward triangle has formed with crude oil, as we'll see. So we'll just go to those other charts. So there's spot copper slipping a little bit further. There's the crude oil chart on a 1 year view. So you can see here we've got a series of lower highs, and we've got these lows through here at about $51. So that is a very clear downward sloping triangle. Now that doesn't mean that it has to fall out the bottom, but certainly the clear direction is that the market is only able to get to successively lower and lower highs So that means that the selling pressure is coming from the top down, and there's not much in the buying side of it, because otherwise we'd be getting higher lows, but we're not. We're not getting higher lows at all. So it's not a particularly great sign for crude oil either. Sorry. Okay. So just to wrap it up, handling extreme volatility that we're almost certain to have is really important, and you've got to try and avoid reacting emotionally to quite dramatic short-term moves. And I think we're just going to continue to see a whole raft of them. You've got to remember the aim is to buy low and sell high. So if you get caught in that cycle of selling into big moves down, then that's what you're doing. You're selling low and then perhaps buying back into the market when you feel comfortable again. And it's an easy mistake to slip into. So the idea is to just consider your strategy and your portfolio and make adjustments ahead of time. Don't wait for the market to fall and then decide that they're not the sort of stocks that you want to have. So I really encourage everyone that listens to this video to just examine their own strategy, your own tolerance to volatility risk, the stocks that are in your portfolio, and just think it through in advance. And if you need to shift, and I'm not saying you do, but if you need to shift your strategy and your emphasis, then you better do it fairly quickly. But having said that, I don't believe in making radical shifts in short periods of time. I think shifts need to be very considered. They need to be progressive. Make them in smaller steps. You don't have to do everything today. But if you decide that you need to make a shift in strategy, then make it decisive and act on it. Don't put it off to see how it feels next week or the week after. It's not the way to be a good investor. Portfolio Analyst this week, no prizes for guessing. I'm going to be focusing very much on risk management. It's ultra important at the moment. So that's it for this week. There's my contact details for any non-members. It's a fascinating time. It really is. I'm not daunted by the current market at all. I certainly have some concerns, and I'm very open-minded to doing some things a bit differently. But I'm not going to be making any dramatic moves in the short term. But I think the really important message is just be very open-minded to to shifting if you need to. That's it for this week. Cheers.